appraisal. Capital budgeting and investment appraisal is the planning process used to determine whether an organization's long-term investment, such as new machinery, replacement of machinery, new plants, new products, new research development projects are worth the of cash through the firm's capitalization structure. So, it is the comparative analysis between the two or more companies in order to choose the best profitable project that is the highly lucrative one. Therefore, the company wants to analyze each and every project to make a better investment decision. Here is the capital investment appraisals. There are different type of methods. So here we have included the three type of the investments appraisals method. The first one is payback period. The payback period is the method of analyzing the investment appraisal. It's an appraisal of a project or of the payback period based on the duration. So it is the case-based system. It is a case-based system. So it is only consider the case transaction, not the accrual-based system. So the case transaction only consider in order to analyze the payback period. It's only consider the cash inflow and outflow, not the cash profit, not the profit of the organization, right? Another method is the NPV and IRR analysis. So the NPV and IRR analysis is the broad chapters we will discuss, right? The NPV and IRR analysis. This is also the case-based systems. So as we know the payback period, the same strategy can be used for the NPV analysis and IRR analysis. It is also the case-based systems. Another one is ARR analysis, accounting rate of return analysis. This is also the one of the method of capital investment appraisals. So this method is, as usual, the accrued based systems. Generally, the accounting systems are using the accrual based systems. So the ARR also analyzes based on the profit of the organization, not the case basis system, not the case profit of the organizations as usually the profit, how much the profit in each and every year. So the ARR analyzes based on the profit basis system. So it means accrual based. Right. First, the payback periods. We are going to have these payback periods and the questions here is given, right? Okay. The first, the company wants to invest its limited money on a machinery. Here's the information relevant to the machinery is given below. Assume that you have been appointed as a project manager of this company. Which project will you prefer? So, based on the information, there are two machines given. The machine A and machine B. Capital of A machine 200,000 and second machine B is given 300,000 rupees initial capital of the machine. So the both machines, they are different value, but the expected lifetime also given the 10 years and 10 years, the same the expected lifetime. So the both they have. So from which we need to analyze the which machine a company wants to invest. On which machine the company wants to invest. So they take decisions from that based on the cash return, not the profit return. So based on the cash return, how much of the company. So from which a company has to analyze of each and every year's the cash transaction, how much. So durations, it's only consider the duration, not companies, the companies futures value, they do not consider. They only consider the company's the case transaction of the project. Therefore, the company each and every year how much we need to analyze. First of all, we consider the machine A. Here's the machine A. The information is given here, right? We have drawn the chart from which we can easily understand and how in order to get such the duration of the profit of each and every machine. Right here, the machine A is given the years 1, 2, 3, 4, 5, 6 up to 6 years is given the information, right? So the profit of the organizations each and every year also is given the profit of the organization. Here the 300, 300, 300, 400, 350, 300, 400. So the profit of the organizations, the beware, this is given the profit of the organizations. We need only the case transaction only, So the profit also the considered based on the depreciation here. So the depreciation also has been deducted. So after the depreciation deducted, the profit can also profit derived. So we need to convert into cash transaction. So the profit, therefore, the profit should be eliminated. The profit should be eliminated. So how depreciation? The company invested 2,000 rupees. 2,000 rupees. So the 2,000 rupees each and every year. So the initial cost of the organization 2,000 rupees. It means the company at the very first time at the zero or year the company invested 2,000 rupees on that machine. That's the cost of the organization. So from the cost of the organizations, they also mention it will the lifetime of the organizations the machines 10 years. So therefore you need to divide that 2,000 into by 10. So you will get the 200 each and every year. Up to 10 years, the 200 rupees as a depreciation. So the depreciation of each and every year, you should add the depreciation because of the expenses or case expenses also being considered. So here we need to the depreciation in order to drive that net cash flow. So here, therefore, the 200, the 200, 200, 200, each and every year we have included, each and every year we have included through 200, 200, 200, 200, 200, 200. So up to 6 years we have given. So the information we also included the 200. So we have, after that, we net cash flow, we drive to 500, 600. So from which we need to consider, the question is the durations, the payback period, how much. So then not the net cash flow. So therefore, we need to consider the first the net cash flow of the profit into net cash flow. We need to convert it, and after that, we need to calculate the cumulative NCF. Right? After that, cumulative NCF. The cumulative NCF of the first 500, we got the first year's 500 rupees, and second year's we got the 1,000 rupees. And the third year we will get the 106,000. At the 3 years 106,000. At the 4 years 2,150 rupees. So here the differences we need the money. Our investment cost is 2,000 rupees. This cost we should get that. We should up to 2,000. So our payback period is the 2,000. So therefore rupees, our 2,000 we need to consider, and we will get the 106,000 up to 3 years. So we need the 2,000 up to 2,000 in order to get our initial cost 2,000. So here between the 1,000 and 100 rupees, 150 rupees, we only consider how much our value, our cost is 2,000, and 1,600 we can get from the year of 3. So the 2,000 into 2,000 minus 106,000, if you deduct 4,000 rupees we need in the year of 4. So in the year of 4, we will have to consider how much rupees years the 3 years we can get the years, and after the 4 years we can't get the whole years. It will not take the whole years. So therefore, you only consider the remaining value in the year 4. The remaining value, not the 550. So not the whole value. We need to take the remaining how much value. At least we need to up to at the year of the 4 for 550 rupees. But we need to consider only 400 rupees, that the remaining value, to get the initial cost 2,000. So the 400 rupees is given. So our total value is the 550, and our needed value the 400. So into multiply in 12, because based on in order to derive the months we need to multiply into 12. So therefore 12 will take to recover those invested money. So the 3 years and 9 months it will take to recover those invested money. Right? In the second project, we can see this is the machine A. We see the machine B here. Years up to 6 years also given. The first 500 rupees, the companies, the initial 500 rupees, and each and every is the profit. So the depreciation, we need to calculate the same strategy can be used here. The depreciations of each and every year, the first initial cost is 3,000, and you have the lifespan of the company is 10 years. So you need to divide by 10, and you will derive and 300 rupees as a depreciation of each and every year. So therefore the depreciation that has to be added because of it is a profit, so it is a non-cash expenses that should be added, that should be added to the profit in order to derive the net cash flow. It's a cash transaction. So the first we will get the 800 rupees, and the second 700 rupees, and for the fourth 600 and 600 800. So these are the net cash flow from which we need to calculate the cumulative fund in order to recover our invested money, initial cost. Right here is the 800 rupees at the first years we will get, and the second years the 700 and 800 plus 700, the 1500 rupees. At the second years we will get the lump sum money. So, and for the third year 650s, and we will get at the lump sum money 2150 rupees we will get, and from which, and the fourth year the 600 rupees the company net cash flow will get. Therefore the cumulative fund, it means the lump sum amount 2750 amounts the company will derive. So from which the company invested 3000 rupees, but at the year of the four, company will get 2750 rupees. So the company if the company reached to 5 years, the company will get 3350 rupees lump sum money. So but only we need to consider 3000 rupees in order to the payback periods. So only we need to consider the payback period is how much. So therefore the company taken to consider in this year 5 whether how much the profit is, how much the profit needed at the year of the 5. So here 2007, the 3000 rupees minus 2750 rupees. If you deduct from the initial cost, we need to the remaining value 2050. So 250 rupees. 250 rupees we needed in the year of the 5, up to in the year of the 5, of which 600 rupees. From the 600 rupees we need to consider 2050 rupees, 250 rupees. So the 250 rupees, how long it will take? So therefore we need to consider this 4 years up to 2150 rupees, up to 2750 rupees, the 4 years it will take, and remaining 250 rupees, how long it will take. So therefore the equation can be used to, and the remaining value to 250 divided by the whole value of the year of the 5, and that is the 600 rupees, and you divide and multiply into 12 because the months in order to derive the months how much. So this is what we got, the 5 months from the value. So totally the 4 years and 5 months the company will take. So that which machine a company want to choose, the very lower the payback period company will choose, because it takes the only the few years the company can gain quickly. So which company wants to choose? The company A is the best option to choose. It takes the lower payback period, right? Okay, the second chapter is the net present value, the NPV. As usually people they know, as we done, the payback period is calculated based on the net cash flow. The same strategy can be used, the net present value, NPV, but the NPV is to consider the whole years, the project years, the project, how long the company will take, and at the whole years company takes the value in order to calculate the NPV analysis. But the payback period only consider up to the recovering value of initial cost, but the net present value is not like such. It is different from that, because it is consider the whole year's value after the initial year to company at the end of the years. So total years can be considered in order to derive the net present value. So the company, or the first we do the questions, after we will have a very deep discussion, right? The first, company wants to analyze a project whether it is started or not based on the information given below. As a manager of this company, what will you suggest regardless of this project? So year 0, year 1, year 2, year 3, year 4, year 5 is given. Those are each and every year. The annual net cash flow is also given NCF. The first 5,000 rupees is the initial cost. In the second years 1000 rupees, 102,000 rupees, and so on, given up to 5 years, right? The discount rate also given, and at the year the discount rate we will discuss later. The discount rate is what the 12% actually is given. So the discount rate is a value, so for each and every year it's a value of the present value of the organization, right? We will discuss, right? Okay, let's do this question first and then we will discuss, right? The years first one, and the year second the 0.9, and the year 0.8, and the year 3 the 0.7, and the year the 4 and 0.6, and the year 5 to 0.5. Here is the value is given, right? How to calculate the NPV, right? It is an easiest process. Let's do this. The year 1, the year 0, 1, 2, 3, 4, up to 5 years information is given, and based on the information we need to get the present value, and from that and net present value can be derived. So the first entry of the 5,000 rupees is the initial cost of the organization. It's a cash outflow. So it is cash outflow. If invested at the year of 0, the cash outflow. So why do you use the terms of the year 0? They say year 0 at that is the company launching the investments, the company launching their project. At the very first time, there's no any operation, there's no earning, or any company, any operating expenses they will not incur, because the company at the year 0 only incurred almost the company's the capital expenditure only. So therefore the year 0, the NCF 500 rupees initial cost of the organizations. So the 500,000 rupees. So the year of the company, the present value is given here. That one is means a discount factor, the company present value. So there is a broader chapter I will discuss you. The company, the discount factors 12%. This 12% equal to the present value. If the year of the 0, if you are invested right now the 5,000 rupees, that the value of 5,000 right now is the 5,000. That's the present value at the 0 of the year, 0 years of the year, right? After the 1 year, the value is not equal to the same. The one not equal to same the year, right? The 0. So after the 1 year, if you are invested, say for example, if you invest the money, 1 lakh, after 5 years it will not equal to 1 lakh. The value can be reduced, right? The value can be reduced. So we will have discussion, right? So we will do this question after we will have discussion, right? Okay. Well, first, the discount factor that this value is given in your right, from which we have to calculate. We have to multiply from this value and shift into discount factor. Multiply this value into, you will get the present value 5,000. The present value you will get the 5,000 is a cash outflow. Right? It's minus value, it's a cash outflow. The second year 1,000 rupees, you need to multiply into discount factor 0.9 value, you will get the 900,000, right? And at the year 2, in you have to multiply 0.8 into 960, and like that you have to multiply the discount factor each and every year. You will get this present value, right? So the present value, the net present value, the present value and net present value, what is the difference? The net present value is the cash inflow and cash outflow can be adjusted, and therefore we will get the value that is the net present value. Here is the initial cost outflow, the 5,000 rupees, and cash inflow 9,960. So if you get the net present value, that minus 300 and 430. So it's a negative value. So if the NPV is negative, the company will not take a consideration. So it will reject automatically. The only company consider if the project only gives a positive value. If it is negative, that doesn't consider to invest the money, right? So here the NPV is negative, therefore this project should be rejected, right? Let's move the question. The third question is what's given, right? So the first of all, we need to consider the internal rate of the return, IRR, and the NPV. So the IRR is the rate of the investment. The IRR and NPV has the relationship. So when we are calculating IRR, they are also needed. So the IRR and NPV has a relationship. What kind of the relationship we will discuss, right? The first, the IRR is the rate of the investment, where an investor expects invested money. The return inflows. So the IRR is means it has a very broad chapters. You will learn in your professional, in your university or any other CEO or CMA, in WT even also you can learn. So this is IRR is a investments, and investor expect the minimum return of his invested money. It's a return of investment. A company, there are different type of the investment company. Also the company need the money to invest, right? Company can't invest the money without money. The company wants to finance, first the company finance the money from the investor or the shareholders or any other debt and equity. From that the company finance, company first finance and then invest the company or any physical assets or any other project in order to gain the profit. So here the terms IRR, the IRR is indicated the company invested return. The company invested return. There's a two kind of the rate, the two kind of the rate is given. So one is the IRR rate, another one is the discount rate, discount factor. It means cost of capital. You will learn, right? The cost of capital. The IRR is mean the company invested any of assets, any of the assets company. It is a company return. Company first finance, second invest the money, finance money, right? So the company invested money, how much return company will gain? How much return company will gain? It is a gain of the company. It is invested any project, any machine, any of the long-term assets in order to gain the profit. It is a IRR rate, internal rate of return. Company expected return. This is the company expected return. So therefore, company consider the internal rate of return whether it is feasible or not. If it is feasible, company accept the project. If it is unfeasible, the company will not accept it. So therefore, both the discount factors, which means cost of capital of the organizations, and IRR has to be considered in order to choose those companies' projects. Right? So the second one is the discount rate of capital. Rate of capital is the rate of where the investor have to provide the certain return of his or her finance money. So it's the rate of the cost of capital. It's outflow of the organization, right? The case inflow is a company invested money. Case outflow, company finance somewhere else, such as the investor like equity holders, right, or debt holders, or the long-term company financing activities such as the debt, right? So like that. So this is the kind of the different kind of the financing activities. So from that the company give financing. So company need the money. So company, in order to come the finance, company have to spend also for those financed money. So if investor like a shareholder invest this money to the company has to give. The company has to give the certain return of them. So this is the case, this cost of capital. First company need the money. First company need the capital. So therefore, so has a cost. Capital has also cost. So company has to give the return as a dividend or something. So that is the cost of capital. So even also company outside from the debt holder. So the long-term debt company can also. So therefore, company has to also give that the debt also. So company also give that the return to debt. So that is also cost of the organization. This is the WACC. It means weighted average cost of the capital. Company can gain. It is a broad chapter. You will learn, and it is also the equations, how to calculate the discount factor, how to calculate the IRR. So it's a deep chapter. But the A-level students only focus in the IRR is what, and the discount factor WACC is what. So that is enough for you, right? Right? Let's see the IRR and the discount rate of the capital have a connection with an NPV, right? What kind of the connection with the NPV, right? The first NPV is minus value, right? It is very important for the when you do the MCQ questions, or sometimes you might be asked this question, this kind of the question. So you should clear the difference and distinctions from the IRR and the NPV. So if you are well familiar with this chapter, so you can easily answer the questions will be easy, right? The NPV is minus value, the IRR and the discount factor and WACC here. The minus, the relationship between IRR and NPV. So the discount, if the NPV is minus, there must be the IRR the lower than the cost of capital. It means company financing cost is higher than company's investor return. Company financing cost is higher than company investor return. Therefore, company it doesn't good to company. So therefore, company has to reject because company cannot survive. The company earning profit is lower than company the cost of capital. Company providing the cost to the capital is higher. So therefore, company cannot survive. So company has to reject this decision, right? If NBV is minus. If NBV is minus, as we know early this question we know minus 400 minus that's a minus value. So therefore company that doesn't good for company because the IRR at the point IRR is lower than the discount rate if it is negative NPV. So that company has to reject the decision, firmly reject the decisions. Company it doesn't give the credit to the company to survive longer, right? The next to the NPV, the values are equal to 0. If NPV value is 0, yes, the company has to take the right decisions. So at the time, the IRR and the cost of capital, means discount factor equal to IRR. If NPV is 0, it means company earning return, company invested return is equal to company cost of capital. It means company financing debt holder, equity holder, company has to provide such a cost. So it is equal, investment equal to cost. At the time company reject or consider other factors. So company may be a non-profit organizations or it may be other factors also. The company welfare activities also may be considered. So at the time company based on it is a project company has to reject this object because there's no any profit so therefore it's rejected. NPV is positive value. The company that has to consider it is very good to the company because company will earn the positive income in future. So therefore, that the relationship between IRR and NPV, the IRR is higher than the cost of capital. So company is firmly accept this project because it gives the NPV positive in future. So therefore, it's very good to the company. So the IRR and NPV has the relationship, right? Has a relationship. So we should understand in order to find that question, MCQ especially, right? That here you can see the investment return, the IRR is a 10% and finance cost is 12%. It is feasible? Not feasible. So company has to reject this. The investor return 10%. The finance cost of the organization for investor, so money to investor and company earn 10%. So it is the 10% earn, but company need to give 12%. So it is not good. It's not fair to company. Company cannot survive. Company the additional 2 rupees has to earn. Company additional 2 rupees has to, therefore the company has to reject this project. So the second option here, the investment return IRR is 15%. So the finance cost WACC, the cost of capital, is 12%. It is feasible because company investment, the return company 15%, but company finance cost 12%. So that saving there's a 3% can save. So company can accept this project, right? Here I have sketched the graph. You can see very for the graphing. Sometimes you might be asked these questions so graphically or sometimes. So it is an advanced process, but even though you should understand and how IRR is correlated. So right, let's see. So the NPV is minus. So it's just an example. It's just an example from this chart. I just drawn this graph. You can see from the IRR and the NPV how each and other how to correlate it. Right. The NPV is minus. The discount factor is the discount factor is 15%. So the NPV is positive 100. NPV positive 100. The discount factor 12%. So here the NPV and the discount factor, the relationships you can see the NPV positive 100. You can see the 10%. It's a very lower the discount factors. If it is increase into 0. So the 0 discount factor 15%. You can see they have the NPV 50%, right? Next one is the NPV is the 100 rupees. The discount factor also the discount factor 20% here, right? You can see from the NPV is minus 100, the discount factor 20%. If NPV is 0, the discount factor 15%. If NBV is 100, the discount factor 10 rupees. So here the relationship you can see, I just sketched the graph here. The discount factor has the highest value. The discount factor has the highest value, 20%. In this graph you can see here percentage. If the NBV is 0%, you can see the 15% of IRR. So the IRR equal to the discount factor at the when the NPV is 0. Here the 15% is the IRR rate. You can call also IRR, internal rate of return, because NBV is positive. NBV is a 0 value. So the NBV 0 value, there's the means company not earning profit, company is a 0. So there's no any profit. So company will earn. So in future, based on the case systems, right? It's not a profit system. It's based on the case systems we consider. Right here, the NPV is 100 and 0. So right, there's a relationship. If the NPV increase gradually, the discount factor will reduce. So there's a negative relationship between NPV and IRR. Right, NPV and IRR. So here's the, you can see here the NPV in this graph. You can see x-axis the discount factors, above the discount factors in this axis you can see the positive value NPV. There the IRR is higher than the discount factor. If that discount factor axis below the axis, you can see the IRR is lower than the discount factor. So company consider only positive side, not to consider negative side. So the company only the good return to the company, right? Next, the accounting rate of the return, ARR. So the ARR is the rate of the return of investment which can be derived based on accounting profit. Unlike cash flow transaction, it not consider the cash transaction, only consider as usual profit. We are doing accounting on the basis of accrual. Right? Therefore, the company accounting rate of return only use the profit-based system, right? Profit-based, accrual-based systems. The depreciation or any non-cash expenses also consider in order to drive the profit, right? Therefore, that it should be considered. So that when the profit derive, all transaction, cash, non-cash expenses can be considered of each and every year. For example, the non-cash expenses depreciation. So almost in your questions can also mention also regularly the depreciations. So the most part the non-cash expenses depreciation in each and every question. Therefore, they touch the depreciation. So you shouldn't forget these depreciations whether to adjust or not. So sometimes they may give in the case basis ARR. So you should consider these depreciations. So they did not consider when they derive the case section into that new you need to deduct the depreciation in order to get such accounting rate of profit. So here the ARRs can be calculated. The equation is given: the average annual profit divided by average investment into 100. You need to multiply into 100 in order to get that rate, the percentage value, right? Therefore, the value is given. So the average annual profit, how to calculate the average annual profit? So the total profit, this is the easy average annual profit. The total profit of every year, the total profit each and every year can be calculated. The years 1, year 2, if it is the 5 years, you need to calculate the 5 years profit, the accrual basis system. 5 years profit, you need to divide number of years. You need to divide by number of years. So you will get the annual profit, average annual profit. So set investment, average investment. This is the almost people very couldn't understand, because the average investment is very, you should set investment at the year 0 and it is investment at the year end. So the investment at the year 0, it means 0 years investment, initial cost plus at the year end in this cost, in this project at the end of the year. So how much the cost of the organization, the last value. Sometimes it may be the residual value of the investment. So if it is residual value, you can consider this is at the end of the year's value. So say the investment at the year 0 and the investment at the year end. Sometimes, example, the 10 years of the project, 5,000 rupees the profit for the years. The profit is same like that, the 25,000 and 35,000, 20, you will get the 15,000 and 5,000 at the year 4. So here the profit of each and every year up to 4 years is given, right? From years you need to calculate the ARR rate. ARR rate, there's the average annual profit you need to take. So therefore average annual profit year 1, year 2, year 3, year 4, and you need to gross value, and you need to divide by 4. You will get 6,250 the average annual profit. So the average annual profit 625, you need to divide by average investment. How do you calculate the average investment? The average investment, initial investment plus at the year end of the cost of the organization, and divided by 2. So 80,000 the initial cost, the company lifespan, the 4 years, and the 4 years there's no any residual value. Therefore, you need to put the value 0. So you need to divide by 2. You will get the 40,000 rupees. That's average investment. So the 250 rupees is the average profit. You need to divide by 40,000 rupees as an average investment. So you need to and by don't forget to multiply the 100 because the percentage value. So the 15.6 percentage you can get. So the company expected ARR 20%, but achievable ARR company the feasible company in this project feasibility 18.6%. 15.6%. It should be rejected because company it doesn't give the credit to the company because the ARR expect 20% at least. So it is lower than expected. So company should be rejected. So let's move the next questions. So here the past paper question 2019 is given. How to see. The Calum PLC is considering acquisition of the machines, replacing the old machine. The management accountant of the company has provided the following estimated information in relation to the new machine. So the pages that I just consider the zero value. It is easy to read and write. So okay, the purchase price 1,200 rupees, as well useful life and 5 years, and residual value 200,000. Okay, initial charges and 75,000. Inside the preparation expenses 125,000. So the additional information is given. So the additional working capital requirement of the new machine is the 300 rupees, which will be the recovered at the end of these projects. The expected annual saving in operating cost due to the new machine is 500 rupees. Expect annual saving is given the saving, right? So it means the company, the profit of the organization. We can say the profit, the cash profit, right? The 5,000. If the new machine is purchased, it is estimated that the old machine can be sold for 400,000 rupees at the beginning of the project. So the company also company old machine. The company replaced very first. Company sold old machine in order to get the money, right? The 400 rupees can be sold at the year 0, right? So before the project started, company sold old machine, and after that company will do its operations, right? And the rate of the return this project, the 12%. The required company the return it means a company they need the 12% at least. So required return it means maybe IRR, right? It may be IRR, right? Okay. The discount factors at the 12% discount factor also given, right? Okay. The discount factor each and every year 0.89, 0.80, 0.71, 0.64, 0.57. So the sometime you may not understand the discount factor is what actually. The discount factor, it's a table value. So the 12% each and every and different type of the value. So the 12% at the year first 0.89 value is given discount factor, and the 12% at the year 2 at the year 3 whether this company pays or not. So this is the question. So what we do? So let's do this 19 part 2 question paper, right? Okay, the year 0 the conduct for the company cash inflow 400. Why 400? Why 400? You see company. Why 400? You see company purchase here is given the 400 rupees. Company at the year 0. Company before project started, new project started, 400 rupees company sold. Therefore cash, if company sold the assets, the old machine, company get the cash 400 rupees. That the year it is happen at the year, right? Therefore, the year 0, the 100 case in 400 cash inflow. That is cash inflow. Any other profit at the year 0, right? You may be confused. So this 500 rupees, why not come? Why not come this 500 rupees at the year 0? Because it's not come because it's still operate. It is a profit after the operation. At the year 0, there's no any operation, there's no any operating expenses. Only consider the cash transaction. The purchase price is of 100 and 200. So the initial cost there, the initial cost of the year, the year 0, we need to calculate. So it's better to calculate, right? So here the cash outflow COF, the 1700. How do you calculate the 1700? So it's a very difficult. So just you see, it's not a difficult, but if you learn very clearly, here we have the value at the year 0, the cash outflow value. The first year you see the 112 to 1,200 rupees, right? 1,200 rupees the purchase price. That at the initial year before company started, right? The year 0, the purchase price 102,000 rupees is the cost of the organizations. That the cost is a cash outflow. So company purchased machine and cash outflow. So that is the 200 rupees. 100 and 200 rupees. The second 75. How do you get this 75? The company, this is also the outflow. The installation charges. You purchase you need to install that machine, right? You need to install that machine. So therefore, the cost 75,000 at the year 0 you will take. Therefore, that is the outflow cash, the 500. That's also considered 75 rupees, right? And another 125 rupees cash outflow at the year 125. That's a site preparation. The expenses, site preparation, that is also incur the cost of the machine. So the year 0. So you need to consider 125 rupees as the initial cost of cash outflow, right? So that is the initial cash outflow. Another one, the rupees is given here. Just to see this additional information there. Additional working capital required of the new machine 300, which will be recovered at the end of the project. So additional working capital required the machine. This means at the year of the 0. Additional working capital required at the year of the 0. So therefore, this 300 is the company cost. Company is therefore this outflow that will be recovered. Just you need to be aware of these questions. Here is mentions will be recovered at the end of the year. So the cost incurred, cash outflow 300 at the year 0, and cash inflow this 3,000 will be get at the year 5, right? Okay, that's 3,000 rupees. So almost 107,000 rupees at the year cash flow. It is cash outflow at the year 0. So it is calculated separately. It is very easier, right? Rather than keeping this value from here, it's very difficult. So I just get this chart. It is very easy to calculate. So from this chart you can understand, very easy to calculate the present value and CF by using this the chart and this methodologies, right? You can use it. It is very easy. Just try to follow this chart. And the professional, let's see this question here. Another one. So the second each and every year. So another one second years. So year first. Sorry, year first. Cash inflow of 500,000 because the company started the operation. Company right now at the year first started the operation, and from the operation cash inflow 500, the saving of the project. It means already the operating expenses deducted, and from the cash 500 rupees. How do you get this 500 rupees? They say it indirectly. The saving is means company 500 saving is mean company. The inflow is means some inflow, and from the cash outflow, that operating expenses, from that the net cash, the 5 flow, there are some cash outflow also there. So that's all. That's it. They do not deduct it. Therefore, you need to consider the cash as a cash outflow in this case. Right? So saving 500 each and every year. So therefore, cash only outflow. So here the second is cash 500 cash inflow and cash outflow 100 and if you deduct from that, you will get the 400 rupee positive value, right? Another 400, the 500 in minus of 400, the same. Here there's a difference. You need to see, you need to separately calculate the year 5 because it's a lengthy process and different type of the inflow cash we need to see. And here the cash 500 rupees year 5, yeah, you can see yes the same 500 rupees it will also company earn the saving 500 at the year 0. But not only this cash inflow of this 500, even also the different type of the these are 200 rupees also additional income because this 200 is what? That's the residual value. The 200 is the residual value. You see here, the residual value, the 200, it will, residual is mean the company after 5 years will sold the assets of 200 rupees. That's a residual value. So the 200 is the income. It is value, the 200 is also the company inflow. And another 300,000 rupees. 300. I also mentioned this 300. Additional 300, it will be recovered at the year end. So that at the year 0 is outflow, but this outflow will gain, it will recover at the year end. So 300 rupees will be at this value. So therefore you will get this 1,000 rupees, the initial cash inflow, 1,000 rupees, right? 1,000 rupees. So you can see the cash outflow as usually the 100 rupees only. Sorry, the minus value 100 rupees. So you will get that how much the 900 rupees cash positive value. So you will get from this, and you need to what to do. So present value you need to take in order to take the right decision based on the NPV analysis, right? So here what to do? The 100 rupees, 100 and 300 minus value into multiply by 1 because the present value in order to derive the present value. So you will get 1000 and minus 1000 and 100, the same value you will get, right? Another the 400 into 0.89, you will get, if you multiply, you will get 356, sorry. 400 into multiply in 0.8, you will get 320, and another one 284, if you multiply, you will get like that. And if you multiply 400 into 0.64, you will get 250, 60, and last you will get, if you multiply 900 into 0.57, you will get 513. And totally the net present value, net present value, NPV, it means the present and the positive value and negative value. If you adjust that, you will get the NPV from the PV, right? So you will get positive, the positive 429. So company earns the positive value. Therefore, the company is a very good to the company to invest. It's a profit, you know. It's company earn the profit because the company is in this IRR, in this discount factor 12%. So IRR almost higher than this value, the 12%. So because the NPV is positive, so company can accept this one. So your recommendation, it should be accepted this project because NPV is positive, right? Okay, let's see another question. 2019, the part 1 question, also the final question is given, right? VC50 number 50, final question. So okay, see, the company is considering the purchase a machine for use in a new project at a cost of 900. The useful life and the residual value of the machines are estimated 5 years and 100 rupees respectively. The expected annual profit of the project is 200, and it is only non-cash expenses depreciation. So calculate the following for this project: accounting credit ARR, accounting credit of return ARR, and the second the payback period. So here's the information you should consider. The company, the project cost, initial cost 900 rupees, the useful lifetime of the machine 500, and the 100,000 rupees as usual company, the annual profit of the company, not some cash outflow inflow, is a company profit, right, of the project. And 200, it's a only non-cash expense depreciation. They mentioned depreciation. This profit also deducted 200 depreciation each and every year, right? Each and every year. So what to do? So you need to consider here the question, the part 1. So the average annual profit right here, the average annual profit. First the questions ARR, right? ARR, you know the equation. ARR is mean average profit, you need to divide by average investment into multiplying 100. You get 900 and 100. If you add that 1000 rupees and divide by 2 and 500 rupees, so that the 500 rupees you will get. So here what to do? So you need to do ARR. You need to calculate. So how much the value. So we need to we also found this value, the 200 the annual profit, annual average profit, and 500 is the value of the average investments. If you multiply, and you will get that value 200 by 500 into 100. So you will get the ARR equal to 40%. Right? You will get the 40%. The first answer is the 40% of your question. Right? Sometimes, so you should understand. You should remind and recapitulate this before you go these exams or these equations. Recapitulate. Don't forget this equation. Sometimes you touch these questions. So you should be clear right before you go the exam. Right? Okay. Let's see. Another question is the payback period. So the payback periods. Somehow in this question they say the profit, the payback period calculated based on the case basis system. So here each and every year, here the information 200 200 200 200 200 profit is given right now. So from that we need to, this is the profit. So if you want to get the cash flow, if you want to get the profit, is mean also depreciation deducted. No, depreciation is a expenses. So when you drive the profit, that expenses as a depreciation, that should be, that already has been deducted. So each and every year. So first we need to calculate the depreciation. How do you calculate the depreciation? So depreciation, the 900 is the given value. The 900, the lifespan of the project 5 years. So 900 the cost and residual value 100 rupees. So the depreciable the value the 800. So if you divide by 500, the each and every year the 160 value each and every year will occur as a depreciation. So therefore the depreciation should be adjusted, because it already has been deducted. The profit derived after deducting this depreciation, we need to add this value. We need to add this value in order to derive the cash flow. The cash flow, right? In order to convert into cash flow, right? So 160, we need to add that value, right? Sorry. So 160 value, right? Here you can say from this value you can get the value. How much? 630. How much? 630. You get over 360, right? So 360. So from this, the payback period. How do you calculate this payback periods? So here you can the cumulative fund. Cumulative fund. The years how much? You can get the 360. Year one, you can get the value, and the second year is 360, and first year and second year, the lump sum value of how much? Just 720. Still not company attained the initial cost. The company has to go for the next year, third years, in order to get the full cost, to recover the full cost. So at the year, if you add this value, exceed the value, they exceed the initial cost value, right? They exceed the initial cost value. So what to do? Company 2 years, 1 year, 2 years, and 72, and third years it reach the value initial cost. Initial cost is how much? The cost of the organization. At the year 3, 1080. So it should be 2 and 3 years. It should be 2 and 3 years. Company recover the money. So first 2 years, the company first 2 years, the 2 years. How many months we need to therefore plus the how many rupees company need? How many rupees company need? The company need from the 70 to 270. Company, you see here. Company need money at the year. Company need money how much? 900. That's the initial cost, right? 900. The value to 720 at the year 30. So at the year at the year 2. So deduct the 720. The value will be given how much? The value 180 rupees at the year 30. So at the year 3. At the year 3, we need to 180 just, not the 360 whole value. The whole value we know it, because company the only T. So that 180 only need from the value, right? Therefore, we need to consider how much at the year 3, 180. You need to divide by 300. 60, and you need to multiply by 12 because in order to derive months, it's based on the month because years also covered. It's between the 2 and 3, that should be a month, right? So therefore we need to multiply. So we will get 6 months, right? We will get the 6 months. 6 months, right? Okay, see here the 6 month, the value also been given, the 6 months, right? So the 2 years and 6 months, the 2 years and 6 months, the project took the company's payback period 2 years and 6 months, right? You all have understood these chapters, and this chapter is very easy chapters if you don't know, but somehow it's difficult to do, but I think you all are familiar. These chapters after this get these points. Let's see and subscribe and share these the chapters, and thank you all.